The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, your weekly source for all things volatility related. My name is Mark Longo from the optionsinsider.com, as well as the old Options Insider Radio Network. And if my audio sounds a little bit different this week, many of you keen-eared listeners will know that NATO is descending upon Chicago this week, so it seemed like a good time to get the heck out of Dodge. So we've moved the whole kit and caboodle down here to Florida for the next few weeks. So I'm not recording from the studio, which is why we sound a little bit different, but everything else, except for the sound of Mai Tai glasses in the background, should be about the same. And as always, I'm joined by the yin to my yang, good old Don Schlesinger from the Volatility Exchange. Don, welcome to the show, sir.
Happy to be here as always and looking forward to today's show.
Yes, this should be a fun one. I love our guests, Don, but I also love when we get a chance to take a little bit of a hiatus from that so we could dive back into the old mailbag. Our listeners are really stepping it up. Did you see the explosion of questions we have for the mailbag this week? There's some impressive stuff here.
We've got Twitter and Facebook and your email and our email, so that's a good thing to do. And as you say, it's great to have the guests, and I'm hoping that everyone them. We're going to have another one next week, but it is good to try to answer as many questions as possible.
Okay, and with that tease for the listener mail segment, we're first going to dive right into our Volatility Review segment.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we look back on the week's worth of action from a volatility perspective. I think we'll mix it up a little bit this week. We always dive into the realm of VIX first, but I know a lot of our listeners really are keen on NASDAQ and what's going out there in the land of NASDAQ. So maybe we'll start there this week. Don, what interesting action did you see in the realm of NASDAQ over at Volex?
Well, it is interesting because it's a phenomenon that we've now been discussing for the past couple of weeks, and I went out on a slightly shorter limb last week. I knew my luck would run out sooner or later in predicting that actual or realized volatility would continue to increase. And I'm going to sort of call it a draw this week. 1 month or 21-day historical vol actually came in a little bit, came in about a point from 1806 to 1707. But at the same time, while that was happening, the 3-month variety actually went up slightly from 14.5 to about 14.8. So more or less, not a great deal on the realized volatility front, but as most people know, with the markets selling off this past week, implied volatility, NASDAQ VIX, and I'm sure Mark Sebastian will talk about S&P VIX, continued to be on the rise. And so that spread that we've been talking about, the risk premium between implied volatility and realized, has widened even somewhat further. And when it starts to get stretched like this, there are implications for just how much longer that can go on. And if you want to know my best take on the reason for this, it's something that we mentioned last week. The decline, although it's been rather sharp over the last couple of weeks, has been more or less steady. If a market goes down every single day, you turn around after 2 weeks and you say this has been a pretty lousy May. But the fact is, it's been a lousy May without any particular volatility or big down drafts in any one particular day. So as measured by realized volatility, you don't have too much movement. But as soon as the market starts selling off, you know that there's that immediate knee-jerk reaction for implied volatilities to go higher. And so that's what we've been seeing.
That's an interesting topic. I know we like to discuss that on the show quite a bit, the old implied versus realized premium. And you brought up an interesting subject there, which I don't think I've ever really sat down to mull over before, but it might be worth parsing out a bit, perhaps with some of our future guests and future shows. We always talk about that implied versus realized premium, but we never talk about maybe the time component of that. We talk about how high it is, how much implied is bid over realized, but there might be some interesting studies to be done there between once the implied premium gets beyond a certain level versus the realized, how long that takes to revert, and if there is some sort of typical time frame. But this usually reverts within 30 odd days, so that might be a good trade here once it gets beyond X percent above the realized, and how quickly it snaps back. Because the farther those two get apart, the more distorted the situation is, which would make you tend to think that it will be reverting sometime in the near future. But when that happens is obviously the million-dollar question. So that might be an interesting question to ask one of the guests who bring on the show who look at this data in much more detail than you or I, Don, is to if there is any data about how quickly it might snap back or revert, or if it does indeed remain in that distended scenario for a significant period of time.
And you know what, Mark? I don't want to step on Mark Sebastian's toes when he will eventually speak about VIX and S&P volatility. But just as I mentioned the levels for NASDAQ, and in line with what you just said, interestingly enough, the S&P 1-month historical volatility, in other words, 21-day real volatility, is now sitting at 12.11. And even as we speak, we're looking at VIX in the 23 handle. So a spread of 11 on that one, which is even greater than the spread on NASDAQ and way beyond historical norms of 3 or 4%. So the idea of doing this as a spread trade when it does get distorted or to historical extremes would seem very interesting to me. And of course, as soon as we bring our realized volatility futures contracts onto the market, first on NASDAQ and hopefully followed by other equity indices as well, it's going to make for some interesting possibilities to do this kind of spread trading between VIX futures and Volex futures and trading that implied realized spread.
That's going to be a fun trade. I'm really looking forward to that. I have to say, Don, you're going to almost always want to be long you're almost always going to want to be short the implied, long the realized.
I think that, Mark was mentioning that this is a spread, and it does occasionally stray, as any spread does, from historical norms. And once again, we're seeing a point where the implieds are considerably greater than the realized. And so if you have vehicles that reflect those two levels and that settle to different components, one to VIX and the other to an actual calculation, you have the possibility of tracking those kinds of spreads and doing those kinds of trades. So when you get something as distorted as it is right now, I don't know if realized is going to go higher, if implied is going to come down, if both are going to happen at the same time. but I don't think you're going out too far on a limb when there's an 11-point difference between the two in saying that that spread is going to narrow. So it would make for an interesting trade.
Yes, I'm sure a lot of our recent guests would have a lot to say on that spread. And
is that the tinny voice of Mark Longo?
It is. And listeners, we are joined, as you might have guessed, by the ultra tinny Mark Sebastian. And yes, Mr. Sebastian, I am a little bit tinnier than normal this week because I am recording from a remote location here in Florida via Wi-Fi. And so not my ideal recording setup, but it tends to get the job done for a portable studio on the go. And Mark, we were just discussing, as Don said, the crazy scenario of implied versus realized right now in VIX land. What else were you watching out in VIX land over the past week while the rest of us were fleeing NATO in Chicago and heading out to parts unknown?
Yeah, I mean, just the implied vol and the skews through the roof. It's been absolutely crazy. And the VIX has just been really overpriced, but maybe rightfully so. You know, it's interesting, Don, the realized vol has been low, but the actual realized vol has kind of a different feeling when it's all in the same direction. Does that make sense? You know, there's a difference between 12.5 vol up 10 points, down 10 points, and 12.5 vol down 20 points in 2 days. And it has a very different effect on retail and even institutional portfolios that maybe it doesn't have the same effect on a prop desk or a market making type desk. And I think that that's kind of something that needs to be taken into account when thinking about why the VIX is so expensive. It's not just that the vol's low, but the movement's been entirely in one direction. So it's kind of interesting if you, and this is going to sound kind of counterintuitive, but you could almost take that vol and double it because it's only been in one direction. So if we take out the assumption that it can go either way, the vol is much higher.
Well, see, this is the thing that makes the implied such a different animal from the realized. And,
Right.
You know, when we get to trading both of them, listeners will have to familiarize themselves. If you calculate actual volatility by formula and the market goes down 1%, then up 1%, then down 1%, then up 1%, and you keep on alternating that, you get 16% volatility. If instead you keep on going down 1%, down 1%, down 1%, you still get 16% volatility. But during such a period, the difference between where implied would be on virtually an unchanged market in the first scenario and where implied would be in the second when we're down 6 or 7% for the month of May is dramatically different. And that's exactly what we're seeing here. By formula, actual market volatility has not been great at all during the month of May. The numbers are what they are, and anybody can look at them. But implieds have been steadily rising because the market has been steadily dropping. And that is, if you will, this, negative correlation, this knee-jerk reaction between, the market is going down, I have to raise the price of all options.
Yeah, absolutely. Agree 100%. So that's the thing is listeners and vol traders need to understand that even 13% volatility can mean two entirely different things. And that's an important thing to understand.
While we're talking about volatility, listeners should know we are recording this on Friday afternoon here. And of course, the ultimate event that everyone in the equity option landscape has been talking about and waiting for months finally occurred today, the Facebook IPO. So hopefully those options will be listed sometime next week.
May 29th.
They have a date now? Okay, I know the
May
OFC
29th is official.
Okay, great. So we should hopefully have something by the time we discuss. We meet again next week. We usually tend to discuss index vol, but because there is so much interest in Facebook now, it might be worth a few minutes next week.
Yeah,
looking back, vol in Facebook land.
Mark, here was kind of an interesting story. I got asked by a Wall Street Journal reporter She goes, well, where do you think the volatility of the options is going to open? My thought is that it's going to settle at a slightly higher vol than Google, and probably which is around 28%, and will eventually, and it's going to open closer to 40%. Was kind of my thought process. I would think it should be a lower vol than LinkedIn, and close to Google. Similar market cap, similar space, similar everything.
I know it was up 12% the last I checked. Is that still where it's trading right now?
Yeah, it's up about 40. It's about 41 last time I looked.
So assuming it settles in around that range.
Give me a second here and I'll let you know.
Assuming it settles in around that range, it doesn't vacillate like crazy over the next week, then I would say that's a pretty safe assumption. And I know your compatriot there likes to look at Zynga as a synthetic Facebook, so he might want to say, well, Zynga implied vols would be the good ways to go.
I don't know if you guys heard about this. This is interesting. This is more of an attributable thing, but around 11:35 Eastern time, a block trade came in to dump Zynga, Facebook, LinkedIn, and Groupon all at the same time. Sent Zynga still halted. Sent Facebook back down to its IPO price of $38. Dropped Groupon $1. Dropped LinkedIn $5. And there were a few other ones. Ren, which is what we call a market special at $5.50. Ren was down over $1. A few other stocks as well. So it was.
Someone was divesting of the entire Web 2.0 sector. They were waiting for the Facebook bump to come in, and as soon as it came in, they got rid of all of it.
They, in the words of Don Schlesinger, they said, "Sold to you, world."
That is a pretty epic "sold to you."
It really was.
Well, I don't have to remind everybody. It's certainly not a remark that hasn't been made a million times, and there are exceptions to every rule, but you know the old adage that by the time the public gets in on the ability to buy these IPOs, the vast majority of the time they wind up losing money. And so, I'm not giving out advice. I'm just observing that historically these things have not been great money makers most of the time. So we'll see what happens with this one.
Hey, Don, interesting. Here's a question for you. When you were on the upstairs desk and you wanted to sell something and you're on the phone with the broker and he says, the crowd's $1.20 bid. Did you just say sell it to them, or did you literally have the guy hold up the phone so that you could say sold to you?
I actually was kind of hard-nosed in my options trading, and along with never enjoying or wanting to buy premium, I also very rarely wanted to sell on the bid, and so I would be rather tough about that and look at the middle of the market, and we traded in teenies or sixteenths those days, and I'd like to try to get off something in between or do part of it on the bid and part of it in the middle. I really haggled a great deal.
You're a squeezer.
I hated selling on the bid and immediately marking it at the midpoint and losing the second that I initiated the trade. So I tried to avoid that as I could.
You were the kind of guy I hated when I was out in the SBA.
I'm sure you did.
John, it's a good thing I like you so much. Otherwise,
I tried to take away that spread that everybody made their bread and butter from, and basically you have to be prepared to walk away a lot when that happens, because then they say, you got nothing done, and you gotta be prepared to say, okay, that's fine with me, when inside, maybe you're not so happy and you're haggling over a teeny or two when it's a $3 or $4 option, and you're looking to sell that time premium and maybe make a good bulk of that. So a couple of weeks down the line, you kick yourself for haggling over a teeny.
I wonder how much time I wasted quoting things to guys like you, Don. Oh, you're bid with me. Why, thank you very much. All right.
Well, or even better yet, they come to the SIBO, get a really, really good price, and then go to the P-Coast and cross it.
That was back in the days when you still couldn't cross things everywhere. Now they just do it in your face.
Right.
And All right, and with that strip down memory lane, we're going to close out the volatility review for this week and dive into an explosive, overflowing listener mailbag.
Listener mail. Listener mail. Listeners write in.
Mail's in.
Mailbox.
And welcome to the listener mail segment of the show. And this is, as I said at the top of the show, one of my favorite times on Volatility Views because the guests are fantastic, but this is the chance when you, the listener, gets to weigh in and participate in the program. And you guys really stepped up to the plate. I'm not sure if it's because we've had so many guests of late, so the mail has just been piling up, or if you guys are just on fire, or a combination of the two. But our mailbag is overflowing with interesting questions. Maybe we'll dive into this one. It's a little bit of a simple one first, but it is very timely, and it'll get some of the discussion going. This is an email from Todd Lundgren out of Pittsburgh, PA, and he writes in, all of this talk about JP Morgan has left me wondering what kind of derivatives hedge loses $2.3 billion. How is that even possible? Help me, Volatility Views hosts. You are my only hope. Well, first off, Todd gets a point for that Star Wars reference in his question. But secondly, this is a very timely question. We've seen this coming in to all of our shows and all of our different outlets here at the Options Insider. Not particularly a vol question, but a very interesting one nonetheless. And I think the short answer to you, Todd, is quite frankly, it's not a hedge. That's
right.
Exactly. That maybe in some way, shape, or form it started as a hedge, but over the months or years that this position was on, obviously it evolved. Exactly. Obviously, it evolved.
They were essentially owning. There was a spread between the insurance on. It was. My understanding is the trade was essentially a spread on bonds versus insurance on bonds that blew up on them. Right.
And we're going to be seeing a lot more of this kind of thing, of dubious hedges in the wake of the Volcker rule, where a lot of these big banks are ostensibly barred from doing these types of proprietary trades unless they are hedges. So we're seeing a lot of people stretching that boundary of what a hedge actually is, and maybe initiating a hedge and then legging into other pieces that make it more of a speculative trade, or evolving these positions in some way, shape, or form. But quite frankly, that definition of the hedge going forward is going to have to be tightened up quite a bit, or we're going to be seeing a lot more of these types of trades, these types of hedges, I should say, blowing up in people's faces going down the road. Don, what do you say about this whole J.P. Morgan fiasco?
Well, of course, the other thing that's so extraordinary is whether you claim that this is a hedged position, which clearly it wasn't, or whatever the rationale, to lose that kind of money, the size of the position has to be absolutely enormous as well. This is not something that gets put on in a day or a week or so. This was something that was, built over a very long period of time, and was an absolutely huge type position that had to have been seen by risk managers, and that's why heads did roll, this past week. And so to lose that kind of money, yes, of course, it wasn't a hedge. There really was nothing offsetting it. So you just had, a one-sided open exposure. That's pretty clear. But you also had exposure in an enormous position. You can just, figure out whether you're doing derivatives or shares or futures, what multipliers are, how much movement you have to have, times the multiplier, times the number of contracts to understand how big this position actually was. And to allow something to ever grow to that kind of size that we now know in retrospect wasn't really a hedge in the first place is obviously inexcusable.
So thank you for that question, Todd. And now we're going to move on to a Facebook question from someone who goes by the handle Ted Moss, I suppose. And he writes, and this is one for you, Don, and if Bob was here, it'd be one for him too, because it's right up your alley. I know Bob and Don are big fans of vol cones. How about a vol cone update on the major indices? And he writes in parentheses, VIX, NASDAQ, Euro, etc. for your loyal listeners. Where should I be buying or perhaps not buying vol here? That's another nod to you, Don. So since you are Mr. Vol Cones, we did touch on this a little bit at the top of the show, but if you want to give a little bit more color, a little bit more flavor for our listeners, by all means, Don, go ahead.
Well, one of the things that I'd like to do, I realize that a lot of our listeners aren't necessarily sitting in front of a computer when they are listening to the show. Some of them are driving, listening at iTunes or what have you. But some, in fact, might have access to a computer. And even if you don't,
Don, I think a lot of people use this show to try and get themselves to sleep.
Well, then, maybe they have their iPhones in their hands. But one way or another, eventually, if you're able to replay the show and have access to a computer, I'm going to take you through a couple of the vol cones, but I'd also like you to try to find this information yourself. It's kind of like the old saying, give a man a fish and you feed him for a day, but teach a man to fish and you feed him for a lifetime. So I'd like to not just tell you what the cones say, but I'd like to teach you how to use them. So our site is volex.us. And then when you get the pull-down menu for data, you just go to vol cones and charts, and up come these interactive vol cones for the Volex indices. So since the question was about the equity indices, you choose that asset type, and the asset, for example, NASDAQ 100 is right on top, and it defaults to looking back 1 year in time, and you get that very typical fanning out of the different percentages, and you take a look at this cone-shaped structure, and starting from the right-hand side, you progress from right to left with 1 month, and then 2, and then 3, and it goes back all the way to -10, and then 11 and 12 as you go back 12 months in time. My feeling is that when you use the vol cones, you probably would like to use a somewhat longer period, because if you're really looking to see historically whether we're at levels that 10% or 90% of the time, or higher or lower or what have you, a slightly longer time frame might be more instructive. So as long as we have the data, and we do, I think it might be instructive to go back at least 5 years or so. And in the NASDAQ, what we see is that 1 month volatility at the current levels, which are about 17 or so, are just a little bit higher than the 30th percentile. So that means that at least about 2/3 of the time, about 65 to 67% of the time, 1 month volatility is higher than what we're seeing right now. If you go to 3 month levels, we mentioned that was at about 14.79, and there you're actually more at about 25% or so. So 75% of the time, you see levels that are higher than where we are currently. And one by one, you can go through the different indices and make similar type statements. I think that when you go to the S&P, you'll find that the levels are even lower, meaning that even a greater percentage of the time, those readings for 1 month and 3 month volatility are higher than what we're seeing right now. Of course, you always want the caveat of being careful when you use historical data to predict what the future might be if you're contemplating a trade. And that's simply because although this is a wonderful tool to use, we can't always take it to the bank. And I think it was John Maynard Keynes who once said, the market can remain irrational longer than you can remain solvent. So sometimes we look at things and say, gee, we're in the 10th percentile, 90% of the time it's higher, I got to go out and buy this. Well, the market just might remain that way for a little longer than you've got money to ride it out. So as always, there's a caveat when using any of these tools. You don't want to use them in a void. You want to make sure to consider as much of the picture and forward-looking predictive possibilities that you have. This is just one thing to kind of put in your trading arsenal, but don't hang your hat too heavily on it.
It's a good point to mention as we were talking at the top of the show about the time frame for the risk premium to revert to the mean, or that risk differential to revert to the mean. It is quite possible that that distorted scenario could remain the norm for the foreseeable future. So definitely keep that in mind as you're looking to potentially spread that, ideally down the road when the Volex products come to market. Speaking of Volex, Don, I guess we'll just keep the ball rolling with you real quick here. This is an easy one. A Twitter question from Uncle Steve, and he writes, "Hey Don, what index is next for Volex after NASDAQ, Russell, emerging markets? Thanks." So Don, that one's right up your alley as well, sir. What is on the horizon for Volex?
Well, of course, I don't think it's any secret that what we'd really like to bring out, and that we certainly hope to bring out, would be the S&P, and there are obviously some issues with licensing and negotiating with various exchanges, but that obviously is the product that is traded right now so heavily with VIX, and we'd like to offer the alternative product along the road. Russell certainly is a consideration. We've actually spoken to the good folks at Russell, and that is yet another possibility. But keep in mind that we really want to offer the broad spectrum of realized volatility products, and we won't limit ourselves to the equity indices alone. If there's interest, and we expect that there will be, we certainly will consider commodities. We could go to precious metals, so it wouldn't be unrealistic to think about oil, Volex, vol contract futures, or gold, or corn, or whatever. If the public has an interest in trading the realized volatility of an asset, we're going to offer contracts in time.
All right, and next up on our overflowing mailbag, we have an interesting email coming to us from Steve K. out of Oklahoma City. And he writes, "Mark is fond of calling NASDAQ Apple Plus," and let me just say as an aside, much to Don's chagrin, do I say that? But Steve continues here. "I know Mark's joking, but it raises an interesting question about how much the Apple tail is wagging the NASDAQ dog. What percentage of NASDAQ vol, or even vol of vol, is directly attributable to Apple? I'm sure your listeners, me included, would like to know. Also, quick side question for Mark. Is there any way to buy Options Insider gear? I love the logo, and I want to do my part to get the word out about the network." Well, let's start with the second part first, because obviously that's far more relevant of a question. And no, the short answer for that one, Steve, is no. We don't have any sort of store functionality up on the site right now, but that might be changing down the road. But you know what? If you provide
I actually think that's something we need to do.
That is something we're planning for 2012, is to get more merchant functionality up and running for the network and for the website, because we get this question quite a bit. I just came back from the Options Industry Conference, which is a big industry show, and I was just besieged by requests for different types of gear. So it is something we are definitely working on. We can do individual ones for different shows. We can do a big shirt with Don's face on it for Vol Views and get that out there, which says, it'll say "sold to you" on the back. I like that.
I do love that.
I'm already brainstorming a lot of ideas, but short answer right now, Steve, is no. But if you provide us with your contact details, because you did write us such a nice question, we'll be sure to get something out to you there in Oklahoma City. And the long end of that is that there will be something coming sometime in the next few months. Don't hold me to a time frame there, but you will be able to sometime in the near future get your hands on some Options Insider and Options Insider Radio Network gear. And now to the meat of your question. Yes, I do joke about Apple or NASDAQ being Apple plus, but there is a modicum of truth to that. Apple is the single largest percentage mover of the NASDAQ on any given day. And I know, Mr. Sebastian, you've been paying a pretty keen eye on Apple these days and watching how it interrelates with NASDAQ. What is your take here on the direct percentage of overall NASDAQ vol that can be traced back?
It's the exact percentage of the overall Apple vol. I mean, Apple is 20% of NASDAQ. You can actually do the math and see what, Apple vol's in 10 points, and you will see the VXN in 2 points. I mean, it's that easy. If you want to see basically it in action, go take a look at what VXN did the day after Apple released its earnings. So if you looked at Apple earnings and you want to see a clear example of Apple having an effect on the NASDAQ, take a look at Apple at what happened to VXN right after Apple announced earnings. It was down almost exactly 20% of the vol that Apple was down. So believe it or not, that percentage that makes up, if you took VXAPL and VX GOOG or VX all those and added them together by their, they would go into VXN at the same percentage as they would go into the NASDAQ 100. It's exactly the same formulation.
Well, there you go, Steve K. An interesting one, and like I said, one we like to talk about a lot on this show, and the answer, as often is the case sometimes, is a little more straightforward than you might assume. And then moving on to another email, this one coming from Max Shrek out of Atlanta, Georgia, and I'm thinking that must be a pseudonym because old school film fans know that's also the name of the original Nosferatu guy from the first Silence movie, and it means maximum terror. So a little bit of trivia for you there. So I'm guessing this is a horror film buff who's writing into us today. And he writes, Vol Crew, I like that, Vol Crew. Why is the VIX term structure coming in so dramatically? The ETP annuities are still net buyers of long-term vol. Now, I know Don and Mark, you guys had a great discussion on this while I was gone a few weeks ago, so maybe we'll just hit on some of the key points of that again. But this is an interesting question, one we receive still time and again. And, the conventional wisdom that people have is that the long-term buyers of this vol, people who are bidding up this term structure, are these ETPs, some of these other, like he mentions, annuities and other players who are net short Vega and have to be net buyers of long-term vol. And they're the ones driving up this ridiculous term structure. And yet we've seen that softening of late. A lot of that has probably been due to fluctuations in the nearer part of that curve as opposed to the long-term curve. But still an interesting question to ponder. Why do you two guys think we're seeing this term structure lighten up of late?
Well, we just talked about what's been happening to near-term volatility. And so when you've got a curve and when the front end of the curve is rather low, as VIX was a month or two ago, looking at, handles in 14 or so, it's pretty obvious that the back end is going to reflect higher levels and you're going to have a pretty steep curve. Now, when 14 becomes 24, there's no reason to assume that, looking out 6 months, a year or more, that those time frames are going to keep a pace with an increase of the magnitude of 14 to 24. So as you just mentioned, Mark, the front end of that curve has gone dramatically higher, and that has the obvious effect, even if the back end stays the same, or even if it goes up a little bit, of flattening the curve. And yet again, this is still another example of, this concept of when you get spreads, if you will. These are kinds of spreads. When you talk about contango or backwardation, it's just really spreads of the far month compared to the near months that basically, when they really get distorted and out of whack, eventually, although we don't know a perfect time frame, they start to come in and restore to normal historical levels. So not surprising to me that this has taken place. And a rather flippant answer to, why isn't it as steep anymore is, well, it was too steep in the first place, so it's returning to more normal historical levels.
Yeah, I think people sometimes, this is a great question, Max, and some people sometimes think that because this thing is not as steep, that there's been some great structural change in VIX term structure, and yet to the most of this activity is really traceable to just that increase in premium in the front month. Think of that VIX term structure of having the fulcrum on the far right end, and it's just swinging up a little bit on the left to perhaps flatten out a little bit. Of course, the far months are being bid up a little bit too, but nowhere near to the degree that we've seen the increase in near-term implieds across the VIX landscape. So, Max, you're right. Those long-term buyers are still out there. They're still buying, but we've just seen a massive swing in the near term, and that certainly has flattened us out, at least for the foreseeable future. We're starting to run a little bit long. This is a great mailbag. I want to keep going. Maybe we'll grab one more here. I'm trying to find a good one to go out on. Here we go. This is a short one, but an interesting thought question, I think, for all of us here on this show. And this is a Twitter question from Todd Dupree. We have the show of Todds today, a lot of Todds writing in. And he writes very succinctly, as is the case with Twitter, has the rise of weeklies rendered existing vol studies and maybe even conventional vol wisdom moot? I think that's an interesting question. We've certainly discussed aspects of this.
No, it has not. No, it has not at all. And that is the silliest. I mean, that is a question of someone who clearly does not understand how volatility works. Please, please, please stop trading options, sir. Immediately.
That's your succinct answer. But no, we've talked about this before in the past where so much of the liquidity now, particularly in a lot of these equity options we've been seeing, has migrated into the weeklies. And I think what he's really referring to, or maybe I'm being charitable with Todd and giving him the benefit of the doubt, but I think what he's referring to is so many of the vol studies and all these different VIX term structure and tail risk and all these different studies we've talked about on the show ad nauseum for over a year now have all really been focused on the monthlies and the front month to far off months. Mm-hmm. Very few of them have actually been adjusted or updated to take into account the way liquidity has changed now. So you're right.
And I have talked about this in the past. That yes. I agree with you, Mark. I've definitely talked about this. I think I was one of the first people to write this. But that said, even it's like SPX, has very active weekly option volume. It's less than 4% of the volume that goes up. In the individual options, it's a little bigger, but it's still less than probably 20% of the total volume. So it does have an effect, and they should rethink some of those approaches. But I would not say that you could just throw out everything, is what I would say.
No, all of the whole world of vol has not been turned on its head. But yet, you're right. There should be perhaps some updates and it's maybe some interesting revisions to what we currently think of the way vol performs. And then that's what I hope Todd was getting at. And if not Todd, I've given you the benefit of the doubt. But and still an interesting thought question for all of us here on the panel to mull, as weeklies are showing no sign of going away. In fact, they're spreading to every product class. And now we're going to have minis and mini weeklies, and it's going to be a whole interesting slew of new products on the horizon. And we'll see how that impacts the vol landscape going forward. Well, thank you everyone who wrote in. We had a great mailbag this week. In fact, we weren't able to get to all of these questions, so we'll have to save some. And if you did write in and we didn't get to you, don't worry, we'll get to you on a coming week. I'm not sure when. We have quite the slate of guests booked for the coming sessions, but maybe we'll try to squeeze in a listener question or two here or there. But again, thanks again to everyone who wrote in. And now we're going to close out the mailbag for this week and dive right into our crystal ball segment.
And now we take a look at the crystal ball.
All right, and welcome to the crystal ball. This is, of course, the portion of the show where we get out our prognostication devices and peer into the murky ether of the future to see what vol has in store for us. And since we started off with NASDAQ in the vol review, it only seems fitting to start off with NASDAQ yet again in the crystal ball. Mr. Schlesinger, going forward, what does your crystal ball have in store for us from a NASDAQ vol perspective?
You know, I think we're reaching a point where if we were asking for predictions about the implied volatility, we would really base our answer just on where we thought the markets were going. The markets have really been roiled this month of May, and we've had practically one down day after the other for most of the month. So if you're in the camp that there's more of this to come, then you have to predict even higher levels of implied volatility. But I'm seeing with realized volatility that either way, whether the markets continue to drop, they seem to be doing so in a rather tame manner. And as a result, it seems to me that should we continue to drop, I don't see any dramatic increase in realized volatility. And should we rise, that often happens in a rather tame way as you kind of climb the wall of proverbial worry. So I'm actually going to now reverse after many weeks and say that we might start to see these realized levels taper off and go somewhat lower in the week to come.
So, not surprisingly, Don Schlesinger saying sold to you from a realized vol perspective.
I have to tell you one other thing, and not to step on Mark Sebastian's toes, but just one quick observation about the S&P. And we've talked about the volatility of volatility many times, and we've actually spoken about how volatility, considered as an asset, if you will, moves itself. And I have to tell you that the actual variability or volatility of volatility recently has been extraordinarily low from a historical viewpoint. We don't have vol cones for vol of vol, but we do have graphs of long-term averages of vol. And you should know that for the 3-month variety, where average vol of vol going back many years for the S&P is in the low 30s, the recent 3-month vol of vol is 11.56.
Wow.
Which is absolutely extraordinarily, like almost at historical lows. The vol of vol is actually lower than the volatility of the S&P itself. 3-month S&P vol is 12.17, and the volatility of that vol is 11.56. That is a rather rare event. So
I was going to say, that's another good question for some of our academics to bring on the show is when's the last time that happened and how frequent of an occurrence is that?
So you just don't see volatility itself moving around a great deal. And again, where it stops, nobody knows. But at least if the markets are going in one direction, it seems that volatility itself is kind of going nowhere at all.
Speaking of going nowhere at all, Mr. Sebastian, what is going on in the land of VIX volatility, at least from your crystal ball perspective?
Yeah, I mean, it's going to be close to 25 on Monday. I think we got a good shot at 30 and maybe worse. So I think that we got some real issues here. And, the trade that here's what I would say is if you're a bank and you're buying treasuries instead of buying something like VIX or S&P puts, you're buying call options on the bonds versus call options on something like VIX or puts on S&P, you're probably doing your bank a disservice. I think that there's there's a lot more room for the VIX to run than there is for something like the bonds. I don't know, Don, what are your thoughts on that?
No, I think you're absolutely right. I don't think you're going to see that kind of movement in the bonds. And if we do get the kind of downside market movement, the other shoe to drop, and the fact that this type of downward action can continue for quite a while, there's no question that you're going to see continuing rise in implied volatility. And again, if we had the vehicle to do the trade, and sadly, we don't have our realized vol products on exchange yet, this would be the type of thing that would be an interesting trade to look at, because you'd have the implieds going higher, you'd have realized kind of hovering, not doing anything. Be interesting to see how the instruments would trade and whether they would permit a profitable kind of a trade.
Yeah, well, Don, do you want to buy a 30-year future for 148, a little over 148?
Pretty scary, huh?
Crazy. I mean, bonds might trade 150, and that's insane.
Your fixation with bonds is pretty interesting these days. You might have to add the fixed income hour to the Options Insider Radio Network.
I think it's such an interesting thing that we're dealing. It's interesting. And I'm about to go a little political. It's interesting that we're dealing with austerity at a time where we've never been able to borrow cheaper, and the Europeans are trying to deal with austerity. It's almost impossible for them to borrow. So it's kind of interesting.
Well, keen-eared listeners will remember back almost a year to the option episode where we dove into bonds at some extreme, and they seemed like a screaming sell at the time, and that, of course, hasn't turned out to be the best trade. So we have been keeping an eye on bonds for a while, but even in this environment, they are perhaps even more intriguing. And you're right with those bank managers. If we do have this extended down period, VIX upside, perhaps even more than S&P downside, is definitely the preferential place to put your dollars, or your hedge dollars, I should say. Unless you're JP Morgan, then don't put any more hedges on whatsoever. All right, and with that shot at our friends over at JP Morgan, that's going to do it for the Crystal Ball segment. That's also going to do it for this episode of Volatility Views. I'm glad we can make it work here from our remote recording location here in the hinterlands of Florida. And I, of course, want to thank my cohorts, my partners in crime, for joining me on the show today. Starting with you, Mr. Sebastian from Option.com. What is coming up in the land of the pit that may interest our listening audience?
Well, there's all sorts of things, but I would just send people to read our blog. I'm going to be doing a bunch of webinars, so you go to our website to see what we're up to. I'm going to be doing CNBC a week from Friday, or a week from today. So actually, if this is on Monday, I'll be doing the CNBC on Friday at 10:30 Eastern time. So you can see me on the old tube then.
And Mr. Schlesinger, what is new in the land of Volex.us that may interest or intrigue our listeners?
I'm not sure we added anything this week. It was a quiet week in realized volatility, so a little quiet week in the volatility of the website as well. But as we went over some of those features earlier on that some of our listeners may have not had a chance to check out, go on over to the website, volex.us, if you haven't visited. There's a wealth of information, and we keep on adding to the volatility library practically every week. New papers come online if you're interested in some of the academic studies. So that is something that changes on a weekly basis. But take a look at those vol cones, get caught up on some of the data, and familiarize yourself with the site, because as we start to trade the products, you'll want to be able to use this as a reference tool.
And, of course, if you want to learn more about any of the topics we discussed on the show today, or check out any of the archived episodes of Volatility Views, and if you missed any, I encourage you to go check out all of those, because we've had some fantastic discussions and some great guests. And if you'd like to check out any of the other programs on the ever-expanding Options Insider Radio Network, then surf on over to theoptionsinsider.com. You can find all of that information there. You can also search Volatility Views or Options Insider Radio, iTunes or Stitcher or the podcast player of your choice. You can find all of that great information and all of our great content waiting for you there as well. So with that, we're going to close out this episode, but of course we want to encourage you to join us again next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.